Hello everybody and welcome to the financial planning update for October 2022, and what a month it's been. Lots to cover, but we will begin as we normally do, just with a brief update on some of the main global markets. It's been a month of recovery in general for markets, and certainly if we take the relative low point at the end of September, some markets have made a reasonably impressive recovery as of the end of October. And as we can see now, some of the main global markets are posting losses that are becoming slightly more palatable now, especially given where we have been, and certainly in the context of the relative low point that we had in the June-July period. Now, as always, I do stress that these are the returns for a sterling-based investor. The S&P and the World Index are down by much more than this in dollar terms, but for a sterling investor, because of the relative weakness of sterling, the damage has been limited somewhat. So global markets starting to look slightly better on a year-to-date basis. Now, this takes in the FTSE 100 in the UK, the S&P in the US, and also the World Index. But as before, there are some notable exceptions to this general sort of picture of improving performance, and that is in the form of the European and the gilt market. Now, both European market and indeed the gilt market have recovered, and the gilt market has recovered very substantially during the month of October, and this is in response to what is now perceived to be hopefully a slightly more stable political environment. Of course, I'm careful how much I say here given the change and the uncertainty we've seen in recent weeks. But the market at the moment anyway seems to be in favour of the change of Prime Minister and the change of Chancellor. And as we can see, the gilt market during the point in the first week or two of October was down something like 30%. And it's closed the month roughly 22% down. So still a very substantial drop on a year-to-date basis, but that's an incredibly significant recovery in only about a 3-week period. So that does show that hopefully things are starting to turn. And we are seeing that reflected in the portfolios as well. And once again, a story, generally speaking, of recovery during the month of October. We see here that the cautious portfolio has actually recovered the most during the month of October, and that's no surprise really, considering that the gilt market has been the major mover. What's also pleasing is if we take a slightly longer term view, this is a 2-year view here, we see now that both the adventurous and the balanced portfolios are now back into positive territory if we look at a 2-year picture. The adventurous portfolio, in fact, now showing a 12.5% gain during that 2-year period. So that's roughly 6.25% per annum. Not quite what we target on the adventurous portfolio, but not too bad nonetheless. And we see the cautious portfolio now making up ground as well. And we may see that continue based on what's happening in the government bond market. And I'll come on and cover that in a bit more detail in just a second. So various things going on at the moment, and I'll save the government situation for last here, but just quickly to touch on the US technology sector. Just in this last week or so, we've had a whole set of results from most of the major US technology firms. And it's fair to say it really has been a mixed bag. Some of the firms have reported actually quite poor results, but some of them, if we look at Apple and to a certain extent Microsoft, they reported surprisingly positive results actually. But the market seems to be tarring most of them with the same brush here. So the market's not been particularly kind to the US technology sector. But those sell-offs, I think it's fair to say, have not all been particularly fair, in that some of the firms have actually posted much better than expected numbers. And in some cases, the market is punishing a slowdown in growth rather than a slowdown in general, if that makes sense. So in some cases, these firms are still posting 30-35% quarterly growth in some sectors, but because that's behind the market's expectation, some of the shares have sold off slightly. So a mixed picture across the US technology sector, which of course now makes up a significant part of the global market. But certainly fair to say that it's not all bad news. There are some positive stories in there, although the market, as I say, is tarnishing some of those companies with the same brush. We continue to see some significant shifts in different sectors of the market. The energy companies, of course, continue to perform very well. No surprise there. We're seeing bumper profits reported by the likes of Shell and BP at the moment. Also, some of the banks and financial companies are now reporting much better results, and generally speaking, the higher interest rates are positive for those sorts of businesses. So they're now benefiting from the change in the interest rate environment that we've seen unfold over the last few months. Now, of course, it would be remiss of me not to mention the situation with the government over the last few weeks. Things are moving so rapidly that even this seems like slightly old news now as I record this video on the 31st of October. But of course, we now have Rishi Sunak installed as Prime Minister. I think it's fair to say that the market is much happier with Rishi Sunak. He would appear to be a slightly more moderate and stable pair of hands as a Prime Minister. And of course, we've got the new Chancellor as well, who has already undone pretty well all of Liz Truss's major sort of budget measures. And again, the market seems broadly in favour of that. And we've seen a significant improvement now in government bond yields, and I'll come on to that again in just a second. We also now seemingly are going to have almost a full budget effectively. They're badging it as an autumn statement, but really we are expecting a full package of measures in a few weeks' time. So of course we'll watch this space. We'll be analysing that very carefully and of course reporting on any significant measures that are introduced from a personal financial planning perspective. But safe to say that it would seem nothing is off the table. We've seen a real whiplash here because, of course, Liz Truss was pulling in one direction. Rishi Sunak now appears to be pulling in almost precisely the opposite direction. So very difficult to tell what might be announced during that autumn statement. It could just be that some measures that were announced but not yet introduced are changed. Perhaps the timing will change, perhaps those measures will be scrapped altogether, or we could even see some changes to the current tax and financial planning environment. So as I say, we'll be watching this space very carefully. No doubt the rumour mill will get going in the next week or so, and then we might start to get a picture in terms of some of the measures that might be announced during that autumn statement. And then finally, as I mentioned, the yield on government bonds has settled to quite a significant extent. And this is the market now really having perhaps a fraction more confidence in the UK government and the UK economy in light of the new government and the new Chancellor. So we move now just to look at UK government bond yields in a bit more detail. And although most individual investors may not be directly exposed to government bonds, that they may well be sitting in some of the funds that we hold. And certainly government bond yields have a significant impact on the savings rates that we receive on our cash that's invested, and also our mortgage rates and borrowing rates as well. So that these yields really are quite relevant to many areas of financial planning. So quite a lot going on here, so I'll talk you through what we're seeing. The blue line represents the rate that we're now paying, or the UK government is paying effectively, on UK government bonds, and that's as of the 31st of October, so that's bang up to date. So we can see here that the red lines represent both a 5 and a 10-year bond. So right now, the yield on a 5-year bond is something like 3.6%, and roughly 3.5% on a 10-year bond. So very little difference between the two. Now the green line shows where we were just 1 month ago. So those yields have fallen very substantially. So on the 5-year bond, just 1 month ago, the yield was 4.4%, now 3.6%. So that's down nearly 1% over that period of just 1 month. And a similar story on the 10-year bond. It was 4.1% a month ago and 3.5% now. So quite a significant change, but rates are still much higher than they were 6 months ago, which is shown in the orange line. Now what's also interesting is that you'll notice that the curve here is relatively flat, and in fact it's what we call a slightly inverted yield curve. And what that means is that you're getting a higher rate in some cases for a shorter term bond, which is quite counterintuitive. Normally you would expect a higher rate if you're locking your money away for longer. So if you draw the line roughly at the 15-year mark, you'll see that the rate is something close to 4%, but out at the 30 or 40-year end of the spectrum, the rate's closer to 3%. So quite unusual, but what that signifies is that the market expects rates perhaps to increase in the shorter term, but then decrease again longer term. So there could be some relief in terms of interest rates in the months and years ahead. So that's everything we have for today. As always, if you do have any questions on your own financial planning, please don't hesitate to speak to a member of the Buckingham Gate team.